let's move to the next one. As I said, we have already seen this. Okay, that is Gordon's model. Okay, we would be revising. Okay, Gordon's model, you can write Gordon's model. Okay, now Gordon's model says that G is nothing but Myron's Gordon. Okay, he says that there is a constant growth in the dividend. G is nothing but R, that is ROC multiplied by retention ratio. Retention ratio. Okay, Gordon's model. Okay, so R is equals to, please write, R is R into G is equals to R into retention ratio. K is what? D1 upon P0 plus G. Okay, D1 upon P0 plus G. Fine. Now that was what we did is cost of capital chapter, right? Now here I have to price the find, so I will have to change the formula. On the left hand side I should have the price. So K minus G is equals to D1 upon P0. Therefore P0 is equals to D1. This G will go this side, it will become minus. Now this P will come this side and it will interchange. P0 is equals to K minus G. Please copy. There are some assumptions of this. Okay, what is the assumption? Again, it's a full equity firm. Okay, and the firm uses only retained earning, means they don't finance by any other source. Okay, and this return R, this is constant. Okay, there are many assumptions here. Okay, R is constant and it's a firm has a perpetual life. There is no taxes and all those things. Okay, so what is the assumption? If you want, you can write in theory if it is asked. I don't think it will be asked in MCQs, but still, no taxes, all equity firm, means only equity finance. Okay, retained earning is only source of finance. Company has perpetual life. Company has perpetual life. Okay, these are the assumptions. R is equals to constant. R is constant. That is return on investment. You know that it is constant. Constantly, what the figure you have, same earnings you will earn every year. These are assumptions. Okay. Next, write the heading dividend. Obviously, if you know the K, if you know the G, if you know the dividend, okay, you can always calculate price. Okay, we will do questions on that later. Dividend irrelevance theory. Dividend irrelevance theory. In bracket you can write MM hypothesis. MM hypothesis. Okay, now what they are saying, dividend is irrelevant. The firm, whatever the dividend policy it has now, MM says that, Miller and Modi Gilani, that the firm's asset does not change. Okay, your shareholders' wealth does not get affected by whether you pay the dividend, whether you not pay the dividend. Okay, so value of the firm now, it depends on the earnings. Okay, well, means value of the firm, they are saying that value of the firm, the company's value depends on earnings, whether you pay that earning to the shareholder or you don't pay. Okay, it does not make any difference. So dividends is irrelevant, that is what they are saying. Now the assumptions what they have taken is very superficial. Okay, that market is perfect. Market is perfect means what? There is no transaction cost. Okay, and all the buyers, investors, they have the full information about the market. You can borrow as much as possible at risk-free rate. So all these assumptions now are weird. Is you can't say that it's a realistic assumption. Okay, there is no taxes. Fine. So all these things are there. Okay, so therefore, but still they have given us, and it is relevant. It makes base for the other theories. So we are going to learn. Okay, so let's write the formula. Okay, please write n into P0. See, this is the value of the firm, n multiplied by P0. ND1 plus N minus M into P1 upon 1 plus KE is equals to N plus M into P1 minus MP1 the whole divided by sorry, 1 minute, I made the mistake in the formula. Here it is actually here only, minus MP1, okay, upon 1 plus KE, the whole numerator, please change it. Is equals to one more formula, okay, N plus M into P1 minus I1 minus X1 the whole divided by 1 plus KE. Put the bracket also here. N plus M into P1 minus I1 plus Xi, I am opening up the bracket, the whole divided by 1 plus KE. Okay, let us understand. P0 is current market price. P1 is price after 1 year or issue price, okay. N is number of shares outstanding at the beginning. M is what? Number of shares issued. Number of shares issued. Number of shares issued. If you check very closely, if you have written, listen, if you check very closely, if I open up this bracket now, this becomes N minus NP1. Okay, here there is a plus, I made a mistake, please correct it. Here there is a plus, not minus, plus. This is plus, this is plus. So if I open, see this and this will get cancelled. So ultimately what is the formula? No, N into D1, how much dividend you paid, plus N into P1, that is what is the issue price and number of shares issued, divided by 1 plus KE. Okay, this is the actual formula in the first case. Okay, that will give you the value of the share. So what I am doing, listen, total dividend paid at the end of the year, because N means how much shares are issued, okay, total price at the end, okay, that makes market cap. I will discount it for 1 year. So what I get, today's price, market value of the fund, N into P0. Okay, if you remember, see how the formula has been done. There is no rocket science in this. Let me write it like this. Wait, N D1 plus N P1 upon 1 plus KE. So NP0 is equal to, I can take N as common, D1 plus P1 the whole divided by 1 plus KE. So ultimately you understand what they have done. This NN gets cancelled. So what is the price? Whatever is the dividend and the dividend you got, and whatever is your closing price, that is discounted for 1 year. So what you get? P0. Understood? So they are only splitting this up. N is the beginning shares multiplied by M plus M. M means new issue. How much you have issued? Why we are issuing? Because we have to take the capital expenditure. Okay, we have to do the capital expenditure. Write one more thing, that I1 and all I have not written. Please write. I1 is equals to investment at the end of the year. Investment at the end of the year. X1 also you write. Net retained earnings. Net retained earnings. net retained earnings. I'll make you understand the formula once we enter into the sums. Okay, net retained earnings. Okay, let's go to question number 4 so that we can understand what it is. Okay, come to question number 4. Present value of the firm. Question number 4. Question number 4 is approach present value of the firm. Shares of Swayam Prabha Limited are quoted at 550 at the beginning of the year, means P0 is 500. It has a capital expenditure of 300 crores. So how much investment is required? At the end of the year, 300 crores. Okay. The cost of equity is 15%. K is 15%. 3 crore shares are outstanding. Now presently you have 3 crore shares. Okay. Ascertain the value of the beginning of the year. Okay. If the anticipated profit for the next year is 280 crores, how much profit you are going to earn? 280 crores. At the time the company declares no dividend, option A is no dividend, option B is 12 rupees per share, and option C is 30 per share. Okay, so let us do one thing. I have written all the things. Okay, let's make 3 columns so that sums get simultaneously solved. Okay, please write whatever I have written. Three cases are there: nil, dividend paid is rupees 12, and dividend paid is 30. Okay, dividend paid is 30 per share. So 3 cases you have. Okay, see, understand the formula, what they have done. Okay, listen. Expected earnings, what they are saying? Expected earnings, they are saying 280 crores. 280 crores. Okay, 280 crores everywhere. Listen first, then you can copy. 280 crores is my earnings next year. Okay, from that, dividend paid, how much I will pay? Dividend paid. In the first case, I will pay 0. In the second case, if you check, I have 3 crore shares. Okay, and if I say 12 rupees per dividend, 12 into 3 crores becomes 36 crores. So 36 crore I will pay. How I calculated? 12 multiplied by 3. Okay, 12 multiplied by 3 crore shares. And the next case, 30 multiplied by 3, that is 90 crores. So tell me one thing, out of 280, this much dividend is gone. So can I say my retained earning is, here it is 280 crores, here it is 280 minus 36, how much it is? 280 minus 36, how much it is? 244 crores. Okay, and here 280 minus 90 becomes 190 crore. Okay, so this many crores I have. Fine. Now please understand, see logically what the formula I gave here, see investment plus XI, all those things. Please understand that formula. What is happening is, I have retained earning 280, but my investment, that is I1 is 300 crores, is 300 crores, is 300 crores. Now if you check, okay, there is not sufficient retained earning. So further equity raised is 20 crores here. Okay, I have to minus this. 280, 300 minus 280 is 220. Extra, how much is required? 280 I have. I want 300 crores. So 20 is the extra. Okay, 56 crores and 110 crores. Now understand, this is new issue, that is M multiplied by P1. M multiplied by P1. This is total value of M is number of shares. P1 is the shares at what price it would be issued. Price at what? the shares would be issued. New price, not P0. Okay. Okay. How I will calculate P1? Okay. How I'll calculate P1? Listen. If you remember, P0 is equals to D1 plus P1 upon 1 plus KE. Yes or no? So according to this formula, I can say that price is nothing but P0 into 1 plus KE. From this I will minus, means this will go this side, this will also come this side, minus D1. So P1 is equals to P0 1 plus KE minus D1. So currently my price was how much? Currently my price was how much? 500. Okay. And 15% is KE. So this is 500 multiplied by 15% minus how much dividend I have paid. I have not paid any dividend. First case 0. So P1, my price is rupees 575. My P1 is 575. Okay. Here 500 into 1.15 minus I have paid 12 rupees dividend. So my price is 563. Understood? Clear? It is not 1.5, it is 1.15. I made a mistake. 1.15. Same way here, 500 P1 into 1 plus KE minus how much dividend I paid? 30, I think. So the price comes to 545. I'll close the window. Understand? I know that this is the value which I have to raise. This is the price at what I'll raise. Can I check the number? Can I get the number of shares? Yes. Number of new shares issued. M is equals to number of shares issued. So that I know how. That is MP1 divided by P1. I'll get M. So MP1 was how much? If you check here, it is 20 divided by price is 575. Okay, this is in crores. So obviously I know that you will have a problem. So take that 20 crores now converted into rupee terms. Okay, so that this is 347. Okay, 3,47,826 something approximately you should get. Okay, here I wanted 56 crores. So 56 crore divided by 563 is my price. Check. Divide and then multiply by 1 crore. You will get the answer. Divide 56 by 563 and then multiply by 1 crore. 9,94,671. Here, how much I had to raise? 110. 110 divided by crore, 545. This is crore. Okay, and multiply, then again convert into this thing, normal. 20 lakh 18,000. Okay, 349. This is the number of shares you have to issue. Okay, fine. So what they were asking, ascertain the value at the beginning if anticipated profit are this. Okay, and they have given us that these are the shares. So this is how we completed the question. Fine. Now till now it is not over. We'll calculate the value of the firm. What will calculate? The value of the firm. Wait, I'll give you time to write. Wait, I'll close the window. See, value of the firm is what? Please understand. Value of the firm means that is NP0 is equals to N plus M into P1, from that minus I1 plus X1. Okay, plus X1 means this I will net it. Okay, divided by what? 1 plus KE. Okay, so listen. Now if the dividend paid is nil, if the dividend paid is 0, okay, at that time currently the shares was 3 crores plus I will issue 3,41,000. So 347. So 3 crore 3,47,826. This is 3 crore plus new shares plus M I will write plus new shares. So this many shares multiplied by, and here what is the problem? You know, you will not, it will not happen on your calculator. I know this sum has a typical problem. You'll have to take it 3.0347286 into 575. Okay, like that. Otherwise it is not possible. Minus 20 crores. Okay, divided by 1.15. Please check if you are getting the answer. This is the value. 3 crore 3.03 you take 3.03 47,826. 826 into 576, okay, is equals to minus 20 crores is equals to divided by 1.15. So I'm getting answer 1500 crore approx. How much I'm getting? 1000. I'll write here 1500 crore approx. 2 crore leave 1.1502 you might be getting, but leave that. Okay, 1500 crore. Okay, listen again. If the dividend is 12, then 3 crore 9 lakh 94,671. 3 crore 9 lakh 94,671. 671 shares I will issue at what rate? At 563. At what rate? 563. Sorry. At 563 into 563 minus, this is not, this is 1 minute. Let me tell you how this 20 crores came out. 300 minus 280. 300 minus 280. This extra what I had to raise now, this 20 crores, this M into P1. Okay, that is net. That is net. Minus 20 crores divided by 1.15. Check. 1499 like that I'm getting. So it is 1500 crore. It is 1500 crores. Okay, extra. Clear? Same way, if I pay 30 rupees this, then 3 crore, how much? 20 lakhs 18,349, this many shares into, what was the price? The price was 545. Okay, minus 20 crores, the whole divided by 1.15. Okay, again you will get what? 1500 crores. See, value of the firm is not changing whenever you either you pay the dividend or you don't pay the dividend. So dividend irrelevancy model, this is what dividend irrelevancy, that is what we proved. Whether you pay the dividend, whether you don't pay the dividend, this dividend is, the value of the firm does not change. Okay, now let's copy this. Okay, let's move ahead. Next question. Okay, question number 5. So many times this has been asked, okay, in the exam. Jamvan Limited, it was in CA final, this chapter. So at that time it was asked, May 2003, November 2006, it was in module also. May 2008, November 2008, May 13, it was there in RTP also. Jamvan Limited has a capital of rupees 10 lakhs, okay, in equity share of 100 each. The shares are currently quoted at par. The company proposes to declare a dividend of 10 at the current year. Capitalization rate for the risk of the class is 12%, K is 12%. What will be the market price at the end of the year if dividend is not declared? Second question, what will be the market price at the end of the year, means P1, if dividend is declared? Okay, so they are proposing dividend of 10. So this is question number 5. Question number 5. If let's say, see, if you remember, what was the formula? P1 is equals to P0 into 1 plus KE minus or plus minus dividend 1. So since D1 is equals to 0, you are not paying the dividend. Therefore, first part, P1 is equals to, currently what is the price? 100. KE was how much? 12%. So 1.12 minus dividend is 0. The answer is what? 112. Simple. Okay. So this is the answer. Fine. This is the answer. Please write. They are paying how much? They are paying 10. So 100, okay, into 1.12 minus 10 becomes 102. So when they pay the dividend for the first question, okay, it is 112 and now it is 102. Okay. Question number, third part. Assuming that the company pays the dividend and has a net profit of 5 lakh and makes new investment of 10 lakh during the period, how many shares must be issued? Use the model. Okay. Is the model, Modigilani and Miller model, is realistic with respect to valuation? What factors might mar its validity? Show how approach affects the value of the firm if dividends are paid or not paid. So we have done that. Still, let us do, please write with me, computation of new shares to be issued. New shares to be issued. If dividend are, first column, if dividend are not paid, second column, if dividend is paid. Investment, I1. The investment, how much you want? 10 lakhs. Please write. X1, that is R minus E. 5 lakhs because dividend is not paid, but here out of 5 lakhs you will minus the dividend paid, that is 1 lakh. Dividend paid is 1 lakh. Remember, dividend paid is 1 lakh. How I came to know 1 lakh? If you go and check, okay, how I knew that it is 1 lakh? If you check the number of shares now, see, let me write it somewhere. Let me write it number somewhere. You also note it. Number of shares is equals to equity capital is 10 lakhs divided by 100. 10 lakhs divided by 100, so it comes to 10,000. 10,000. Okay. So dividend is equals to 10,000 multiplied by 10 is equals to 1 lakh. Please write this somewhere. Okay, this working should be done somewhere. You can include after this table also, it's okay, leave some space and do this. Okay, so otherwise there will be confusion how much has been paid. So this is 4 lakh. I'll close the window. Further, equity raised, investment is 10 lakhs. Okay, investment is how much? 10 lakhs. Fine, 5 lakhs I have, 5 lakhs I have, right? So how much I have to raise the equity? 5 lakhs. 10 lakhs minus 4 lakhs, 6 lakhs. Okay, P1. Okay, P1. So this is nothing but MP1. Okay, P1. If dividend is not paid, then price was 112. If dividend paid, 102. So I can calculate M. M is equals to MP1 upon P1. Five lakh divided by 112 becomes how much? 4465 shares. 6 lakh divided by 102, 5883 shares, round it off. Okay, these are the shares which has to be issued. Done. Last question, in between they are asking what is the value of the firm when dividend is paid and when dividend is not paid. So again I'll have to do the same thing under MM model. Value of the firm under MM model. If dividend not paid, first right here current market value, N into P0. Currently the market number of shares is 10,000 and price is 100 they have given. Current market price is 100. So it comes to 10 lakhs. Okay, this is current value. If dividend is not paid, then 10,000 existing share plus 4465 is what I'll issue, correct? Into price is 112. Price is 112, right? Okay, minus 10 lakh plus 5 lakh. 5 lakh was my retained earnings, correct? Divided by 1.12. 1.12. Check what answer you are getting. Check what answer you are getting. 10 lakhs. It should be 10 lakhs. There is no change in the value whether dividend paid or not paid. If dividend is paid, then extra 5883, but the share price is 102 minus 10 lakh plus 5 lakh. Okay, upon 1.12. If you check again, the answer should be 10 lakhs. Okay, again the answer should be 10 lakhs. Okay, so we have answered the fourth question. Okay, what is the Miller and Modigliani realistic? Sorry, fifth question. In between we have left one question, fourth one. Let us answer that. What are the problem with this model? Okay, let us write first practical problems. Practical problems. Practical problems with model, with MM model, with MM model. Practical problems with MM model. First, presence of taxation. They say that taxation should not be there. Presence of taxation. Okay, and flotation cost. Flotation means issue cost. Okay, whenever you issue any equity or debenture or any equity, you have to incur underwriter's commission and all those things. So that cost. B, tax rate difference between ordinary income and capital gain. Capital gain tax is different on investment, right? And income tax rate is different. C, investors prefer present income rather than future income. So if company is paying the dividend, okay, they love it. Who? The investors, because they prefer the money coming in. Okay. At the next model, it is called Lintner's model. Lintner's model. Lintner's model. Not Lintner's, Lintner's model. Not N is not there. Lintner's model. Lintner's model. D1. This is the model now which is based on dividend, not on price. It gives you expected dividend. This formula is for dividend. D0 plus AF is adjustment factor, E1 multiplied by target payout ratio minus D0, and then the bracket close. This is bracket, this bracket. Okay. D1 is expected dividend, D0 is current dividend, AF is adjustment factor, TP is target payout ratio, E1 is expected earnings. Please write. So what this formula says, what is the adjustment factor? Let's say currently you are paying 10%. You have to reach 50% in 5 years. Okay. So let's say 60%. So difference is how much? 50% you have to gain, right? So that 50 is divided by 5. Means from 10 you have to move to 60% payout. Means that gap 50% divided by 5. Every year 10% you will adjust. That is adjustment factor. Okay. So the formula is designed in such way. Okay. This is not that famous because our adjustment factor is arbitrary. Okay, so fine. So let's go to the question. Adjustment factor will be given in the exam. Okay, but I just made you explain what the this Lintner wanted to say. Okay, Lintner wanted to say. So Surbi na, see the question number 6. Question number 6. Surbi Limited follows Lintner's model. I think the name you'll have to check. It is Lintner, I think. Okay, model for the dividend distribution. Last year it had declared ₹5. Okay, last year D0 was 5. D0 is equals to 5. Its target payout ratio is 70%. See, I have to reach till 70. If the EPS is ₹10, if earnings is ₹10, ascertain dividend payout ratio. If the Surbi Limited views that only 50% of the incremental dividend can be maintained in the years to come. Okay, that means what? Only 50% of the dividend can be maintained. Means only you can go for 50% dividend, okay, in the coming years. And what they are saying, 50% dividend means, understand, if 50% is what adjustment factor, okay, 50% I will adjust, that is what they are saying. Fine. So if it is adjustment factor is 50%, what will be your dividend, expected dividend? What will be the dividend payout if the Surbi can maintain 70% or 30% of the incremental dividend? How much is the increase? 70 and 30. Then what will be the expected dividend? So three cases are there. First thing, listen, D1 is equals to, if you remember, D0 plus adjustment factor, which is keeping on changing, 50, 70 and 30. Okay. And here inside E minus D, E multiplied by TP, target payout, and then from this you will minus what? Dividend. Okay. So see exactly what is happening, just for the sake of understanding. We will do it nicely. Listen. If adjustment factor is 50%, means I will be only, whatever is the increase is there now, of that I will be in only, whatever the dividend I am increasing, out of that only 50% is sustainable. I can only pay 50%. Then adjustment factor is 50. If you check the earnings what is given is, let's say, 10. Okay, I have payout. How much I have to reach? 70%. So 7 is my earnings. See, out of 10, I have to pay 10. How much I am paying? I am already paying 5. That means how much should be the increase? 2. But I can't maintain this 2. I can maintain only 50%. So that is 1. So 5 plus 1, this becomes 6. See the understanding, the logic. Okay, 10 is my earnings. Okay, 70% is my payout. So I have to reach 7. But already I am paying 5. That means extra how much I have to pay? 2. But how much I can sustain with this increase? This 2 fully I can't pay. I am saying 50% I can pay. So 50% of 2 is 1. So 5 plus 1 becomes 6. Okay, this is the understanding. Okay, now let's do one thing. Let us, three things are there. Three adjustment factors keeping on changing. Okay, so let's say first time the adjustment factor is 30%, next time the adjustment factor is 50%, and the last one adjustment factor is 70%, what is given. Okay, so let us do this. Okay, now D1 is equals to, D0 is 5 plus 0.3, that is adjustment factor, my earnings is 10 minus, into my payout is how much? 70%. Okay, and from that I will minus already paid, that is 5. So 5 plus 0.3 into 7 minus 5 is 2, this will be constant. So 5 plus 0.6, answer is 5.6. This is the dividend. Okay, fine. Next, here D1 is equals to, again 5 plus adjustment factor is 50%. Okay, again 7 minus 5 is 2. Okay, so 5 plus 1, it becomes 6. Now that bracket I am not writing again and again. 10 into 70% is 7. 7 minus 5, that is constant. Okay, D1 is equals to 5 plus this my time the adjustment factor is 0.7. So again here it will come 2. Okay, 2 into 0.7 is 1.4. So 5 plus 1.4 becomes 6.4. Understood? Like this. Okay, please copy this. Done. Lintner's model. Easy. Okay. Understand? Now the next is something called as radical approach. This is just a theory, okay? There is no questions on this radical approach. This is based on the tax, okay? Based on tax. See, when you buy and sell the shares, you attract capital gain, okay? On that capital gain, you have tax. Even when when the dividend is paid, you have tax on that. So what this people say, tax on dividend, if tax on dividend is less than tax on capital gain, okay, then you should pay dividend. You should pay what? Company should pay dividend, because tax on dividend is less now. Simple. If tax on dividend, same tax on dividend, okay, is greater than tax on capital, okay, then no dividend, okay. That is what, let you grow in price terms, and when the investor will sell, he will attract capital gain and it will be less, okay. Please write this. This is called radical approach. No questions on this, okay. Okay, now the main part is valuation of shares, right? Valuation of shares, right, in bracket, dividend discount model. Dividend discount model. Valuation of share, dividend discount model. To understand exactly what we are doing is, whenever there is valuation involved, now what we do, we pull the cash flows. In equity share, what is the cash flow? The dividend, okay. So whatever dividend are there, D1, it will be pulled at KE, okay, raised to 1 plus D2 upon 1 plus KE, the whole raised to square. Like this, you will keep on pulling till you know the dividend, that is Dn upon, till the year you know, KE raised to n, 1 plus KE raised to n, and this gives you what? P0. This P0, the value according to you, is called intrinsic value. Is called what? Intrinsic value, okay. Please copy this. Please copy this. Okay, listen, three type of questions comes, means growth variant, you can say growth variant, three type of questions, wherein the first type is, okay, you have zero growth. What you have? Zero growth. Let's say there is no growth. If there is no growth, then formula becomes P is equals to, since D upon KE. If you remember this, we have done in cost of capital, okay. Second is constant growth rate model, that is Gordon's model. Today also we saw the formula, constant growth rate model, okay. Constant growth rate model, that is Gordon's model. In that, P0 is equals to, you take D1 upon KE minus G. This is the formula, correct. And then there is variable growth. Then there is variable growth. Understand, variable growth means what? See, in constant growth rate, every year it was 10%, 10, 10, 10, till what? Infinity. But here what happens? First year it is 5%, second year again it is 5%, third year it may be 10%, like that fourth year it may be 10%, okay, fifth year it may be 10%, after sixth year to infinity it is constant at 5%, something like this, okay. So make it 15, 15. So from 15 it goes to 10, okay. Copy this. This is growth variant, okay. These three types of questions will be there. How to solve, we will learn, okay. Question number 8. Come to question number 8. Rama Limited. Okay. Rama Limited had declared an annual dividend of 4 per share. It is expected to grow 20% for next 2 years, 10% thereafter. Means first 2 years it is 20%, then 10% forever. The required rate of return is 15%. This is the discounting rate. Calculate the current market price of the share. Okay. So remember, see, year 1, 2, again I will write here 2. Why? I'll tell you. This is step 1. This is what? Step 1. Calculation of price. Okay, here what I am doing is growth is 20%. Is 20%. This is 2 to infinity. They are saying how much? 10%. Okay, so this is my growth. Fine. Expected dividend. Remember, expected dividend. This is my cash flow. This is what? This is my cash flow. So currently the dividend is 4. It will grow by 20%. So answer is 4.8. Understanding? Then 4.8 will grow by 20%. Okay, so answer will be 5.76 plus 20%. Okay. Discounting factor at the rate. What was the discounting rate? 15%. Remember, and will calculate PV. Okay. Wait, the sum is not over. Let me complete this. Then you can go ahead. Okay. There is calculation of present value of dividend, that is constant growth rate, which is constantly growing to grow, now constant growth. This is called horizon period. What it is called? Horizon period. That is P2 to infinity. This is called horizon period. Horizon period. So here I will apply Gordon's formula. See, if I have D3, I will get price at the second year, 1 year back, upon KE minus G. Second year, it is dividend is 4.8, but it is constantly going to grow by 10%. So 1.1 I will multiply. Okay, sorry, not 4.8, 5.76 is my dividend. 5.76 into 1.1. KE is 0.15 minus growth is 0.1. So please give me the answer. 576 into 1.1, that is D3 when divided by KE minus G. Answer is what? 126.72. This is accumulated value of all the dividend from 2 years to infinity. Okay. So then what you will do is you will apply the factor 15%, 0.8695, 1.15 divide equals to 0.7561, again 0.7561. Remember, both are at the same time. Okay. So then you will calculate present value. 4.1736, 4.8 into 0.8695, 4.1736, 4.355, 4.355, and then 95.813. Check. The total should be 104.34. 104.34. Please copy this. This is how you will value. Okay, intrinsic value of the share is 104.34. Based on that, for 2 years it will grow at 20%, and from 2 to infinity it will grow constantly at 10%. Then what is the value of the share today? 104. What is 126.72? From 2 to infinity, if dividend grows by 10%, what is the present value of that? So stock price at the end of the second year is 126.72. Okay, please copy. Let's go into next question. Question number 9. Rishabh Limited. Rishabh Limited had just paid out 5 rupees dividend. That means D0 is 5. The past dividend trend indicates that the dividend outgo increases by 10% per annum. The company foresees this growth rate for next 2 years, after which the dividend will outgrow for 12% for 3 years and thereafter 12.5% for 2 years. Okay, after that, in point, it is expected that annual increase in dividend will be fixed at 11%. What exactly they are saying? If I want to write this, see here, or I can directly write calculation of price. Calculation of price, if you remember, see here, then growth rate. So I'll read again the question. In year 1, they are saying 10%. For how many years? For 2 years. Check. For 2 years, they are saying 10%. Okay. Then what they are saying? The company foresees growth rate of the dividend for the next 2 years. After, the dividend outgo will increase by 12% for the 3 years. Okay. Now it is 10. Then for 3 years, it will be 12%. Okay. Then afterwards, what they are saying? Thereafter 12.5% for 2 years, means 6th and 7th 12.5%. Okay, then 7 to infinity. Check what they are saying. 7 to infinity, they are saying that thereafter, see, after that point in time, it is expected that annual increase of the dividend will be fixed at 11%. Okay, here we will apply constant Gordon model. Okay, 7 to infinity. If the expected return is 17.5%, that means K is how much? 17.5. Asset and the theoretical market price, means PV. Assuming dividend outgo is the sole determination of the market value, means dividend is only one factor by which you can calculate the growth. Okay, so let us start. Here I'll write expected dividend, or I can write cash flow. Okay, what is my cash flow? Currently the dividend is 5. 5 plus 10% is 5.5. 5.5 plus 10% is 6.05. 6.05 plus 12% is 6.776. 6.776 plus 12% is 7.5891. Plus 12% is 8.4998. Plus 12.5% is 9.5622. Plus 12.5% is 10.7576. Plus 11%, I will have to calculate. Okay, 1 minute, this I will take here. To calculate D7, I should take, sorry, to calculate P7, I should take D8 divided by K minus G. Okay, D8 is how much? 10.7576 into 1.11, the whole divided by K is 17.5%, so 0.175 minus 11% is the growth. 11% is the growth. Check how much you are getting. This price P7, if I want, I should take D8, because if I take D8, 1 year back value I will get, that is P7. So this is 183.70. So 183.70 is what? Is the present value at the end of 7th year of all the dividend after 7 years till infinity. Okay, now I will take discounting factor. Discounting factor at the rate, I think it was 15%, I don't remember. No, 17.5. Okay, 17.5%. Fine, 17.5%. Okay, then I will calculate PV. Come on, complete this. Copy this and complete this. Okay. Let us come to question number 10. See question number 10. Now this is a disputed question from, means solution is disputed from the CA final point of view. Okay. So risk-free rate is given 9%, expected return on market is given 13%, growth rate is 7%, last dividend D0 is 2%, beta of the company is 1.2. So obviously beta is given, RM is given, means CAPM. Okay. So what is the equilibrium price of the equity stock of Platinum Limited? Okay. So what you have to do, listen, I'll first summarize. See, this is what is given in the question. RF is 9%, RM is 13%, growth is 7%, D0 is 2, beta is 1.2. They have asked us equilibrium price, and then they are suggesting some changes, that is inflation premium is increases by 2%, then expected growth rate increases by 3%, beta is 1.3, then what will be the price? So I had made two columns, okay, before change, after change, okay, and I am applying the formula 9 plus 1.2 into 13 minus 9, okay. So 13 minus 9 becomes 4, 4 into 1.2 is 4.8, so this becomes 13.8. Second, P0 is equals to D1 upon KE minus G. So D1 is what? D1 is 2 is current dividend into 7% is the growth, constant growth, upon KE. Just now I calculated 0.138 minus growth is 0.07. So I'll calculate the answer. Rupees 31.47. Okay, this is the price. Now going back, listen, when RF, see, inflation increases by 2%, obviously inflation is included in risk free. Okay, risk free rate should adjust according to inflation. Fine. So RF would change. 9 into 2% growth means my new RF would be 9.18. Okay. They are saying that the growth is increased by 3%. Expected growth is increases by 3%. So G is 7 plus 3 is equals to 10%. Now you will ask, sir, inflation also increased by 2%. Why you have not taken 9 plus 2? Understand, 2% inflation hike is a very big matter. Common sense. Okay. Inflation does not rise by 2%, 3% like that. Company's growth 3% is normal. Okay. 7 into 1.03 is minuscule, very small thing. Understood? So you have to be careful that what we are doing. But ICINA gives you both the solutions, wherein 9 plus 2 it becomes 11, the RF, therefore I said disputed. Okay. So beta is 1.3. Beta is what? 1.3. So both solutions are correct. Okay. In recent suggested they have given both answers as correct. So now I will calculate KE. So how I will calculate KE? KE is equals to 9.18, that is RF, plus beta is 1.3, RM minus RF. RM is 13 minus RF is 9.18. Okay, so my K is how much? 13 minus 9.18 into 1.3 plus 9.18. So it is 14.15%. T0 is equals to, my current dividend is 2, my growth is 10%, so 1.1 divided by my new K is 14.5 minus my growth is 10. So my price is how much? $53.01. Okay, please copy. Okay, done. Let's move ahead. Question number 11. A company has a book value. A company has a book value of 137.80. ROE is 15%. Follows the policy of retaining 60% of its annual earnings. If the opportunity cost is 18%, what is the price under the perpetual growth model? Perpetual growth means same. What we means Gordon's model. Okay, so we have to apply the Gordon's model. So let's go slow. Listen carefully. First thing, the return on equity is given. Okay, so you should know the ratios. Otherwise, the sums would not be solved. Return on equity is nothing but PAT, okay, upon net worth. Upon what? Net worth. Okay. So ROE I know, correct, but I don't know the PAT. Related to PAT, what I know is, see, if you check, the book value is 137. Return on equity is given. 60% of the follows the policy of retaining 60% of its annual earnings. Means 40% is the dividend payout. Okay, and opportunity cost is 18%. So here we will have to modify the formula. What I'll tell you, listen. Now in this case, if I divide this by n and divide this by n, so what I get is EPS, okay, earning per share upon book value per share, BVPS, book value per share. Understood? So what is happening, guys? That is, I can say EPS is nothing but ROE multiplied by book value per share. Sir, but why you are doing this? Because I know the ROE, that is 15%, and book value per share is 137.80, which is given. 137.80 book value per share is given. So I modified the formula according to me. I divided PAT and net worth both by n, so I got EPS and I got BVPS. Okay, and when I multiplied ROE with BVPS, I got EPS. So 15% into 137.80. So 15% of 137.8 comes to how much? Rupees 20.67. 20.67. Understand? So out of this, 60% is retained. Out of this, 60% is retained. Okay. If I retain the 60%, how much is my earnings? How much is the dividend payout? Sorry, dividend payout ratio is 40%. So 60% means I'll check. Okay, dividend per share is equals to 20.67 into 40% is my dividend. Okay, it is rupees 8.4. Check how much it is. 26, I think. 8.26. 8.26. This is the dividend. Okay, what will pay dividend per share. Understood? So this is the sum. Okay, sum is not yet over. Wait, let me complete this. Now, sir, why you did all these things? Listen, I have to solve the firm using constant growth rate model. So first thing I should know is G. Now, what is the formula for G? G is, 1 minute. So how we will calculate the G? Because for the constant growth rate Gordon's model, we want G. G is B multiplied by R. B is what? Your retention ratio. B is what? Retention ratio, which you have already calculated. And R is ROE. Okay. So once you multiply this, you will get the G. Okay. ROE multiplied by retention ratio. So my retention ratio is 60% and ROE is 15. So 15 multiplied by 0.6 or 0.6 into 15. Any one thing you have to take in decimal. Okay, 0.15 or 0.6. So this comes to 9%. This comes to how much? 9%. So once I know the growth, I can calculate P0 is equals to D1 upon KE minus G. So my dividend is how much? 8.26. In that there will be 9% growth upon KE is 18%. Okay, K is 18%. Okay, which is given in the question. Okay, minus 0.09. The answer comes to how much? 91.78. 91.78. Okay, so this is how the sum is solved. Fine. There is some assumption which I'll tell that you have to write. Okay, start copying. write the assumption right below this question, the assumption. Okay, what is the assumption here? The EPS is assumed to be expected. Assumption in this question, EPS is assumed to be expected, assumed to be expected. Hence, dividend is also at the end of year 1. At the end of year 1. Alternatively, EPS can be assumed. EPS can be assumed at 0th year. At 0th year. 1 minute. 1 minute. 1 minute. EPS is assumed to be at 0th year. Sorry. Correct this. At 0th year. And hence dividend is also at year 0. Dividend is also at year 0. Alternatively, EPS can be assumed at first year, that at assumed as expected. Assumed as expected means you can assume that EPS to be E1. Then if it is E1 now, listen, first write this. EPS is assumed to be at 0th year, hence dividend is also at the end of year 0. Alternatively, EPS can also be assumed as expected, means E1. So if this is E1, then this is D1. No need to multiply here with 1.09. Okay, that is the stuff. Okay, then too, because the question is not clear. Fine. Next question. Question number 12. Hari Limited is all equity financed company and has a paid up capital of rupees 10 lakhs. The company has hired Swastika consultant to analyze the future earnings. The repost of Swastika consultant states as follows. The earnings and dividend will grow at 25% for the next 2 years. They are saying that earnings and dividend, very understanding question. See, it's a all equity financed. There is 10 lakhs paid up capital. They have hired Swastika to analyze the future earnings, how the earnings will grow. Now earnings and dividend, the consultant says earnings and dividends will grow at 25% for the next 2 years. Earnings are likely to grow at 10% from the 3 years onwards. Future, third point, if there is a reduction in earning growth, dividend payout will increase to 50%. Okay, means dividend payout will go down. Other data related to the company are as follows. 2012 to 2016, they have given us the EPS, they have given us the dividend per share, they have given us the share price. Tax is 30%, not expected to change in future. Post-tax cost of capital means discounting rate is 15%. Okay, by using dividend valuation model at the year end of at the end of the year 2016-17, make it 2016-17. Okay, if there is one, make it 2016-17. Expected market price per share you have to calculate. No, sorry, it's correct. By using a dividend valuation model, calculate the end of year 2016. First question is, it's not 2016-17. At 2016 you have to calculate first question expected market price per share, and second is P ratio. Okay, so how we will do this? Understand. Listen, let's go ahead. So how we will solve this? Okay. Now what is given in question number 12? See, in question number 12, understand, we have read the question. Okay, let us understand how to be solved. Okay, they have given us the data till 2016. Okay, so EPS is 6.30, 7.70. Okay, then 8.40, then 9.60, this is given, and you have DPS, that is 2.52, 2.80, 3.08, 3.36 and 3.84. okay, now listen, if I calculate dividend payout ratio, check DPS divided by EPS, that is 2.52 divided by 6.30, 2.52 divided by 6.30, how much it is? 40%. Check the next one, check the next one. %. So all this now, if you check, this is 40, this is 40%, this is also 40%, this is also 40%. Till 2016 it is 40%. The data is given. In the question they are saying that, go to the question, earnings and dividend will grow at 25% for the next 2 years. Means here this will grow by 25% plus 25%. So in 2017, 9.6 plus 2.25% would be 12. How much it is? 12. Correct. And also this 25% means 3.84 plus 25% is 4.8. So here also it will be 40% only, the same. Okay. Now what happens? 2018 they are saying next year again this will increase by 25% for 2 years. So 12 becomes 15 and 4.8 becomes 6. Okay, again the dividend payout is 40%. Okay, fine. The earnings are likely to grow by 10% from the third year onwards. So that is in 2019, this will grow by 10% plus 10%. So it becomes 16.5. It becomes how much? 16.5. Okay. Now it becomes 16.5. What is they are saying? If there is a reduction in the earning growth, dividend payout will increase to 50%. Dividend payout will increase to 50%. That is what they are saying. Okay, what does this mean? So because the earnings means earning growth has gone down from 25 to 10%, therefore this time my payout will not be 40%, my payout will be 50%, and if my payout is 50%, that means my dividend here is 50% of 6.5, that is 8.25. Because here there is a fall, therefore this has got increased. This is what given in the question. Okay, so now how to solve? Please understand, this is what I know from 17, 18, 19 data I will use, and then I will calculate market price. So listen carefully. Calculation of market price, that is PV I will have to calculate. So I will write here, that is 2017, 2018, 2019. Okay, so cash flow, this is dividend, here also this is dividend, and this is market price. Market price which is given as, if you check market price now, check in the question what is given, that they are saying that in 2000, see they have given us now what is the market price, check, or what they have given that it will constantly grow by 10%. So 2018 I can obviously calculate, not 2019, sorry, 2018 I can calculate. So because I know constant growth rate model, because I know price of 2018 will be, price of 2018 will be dividend of 2019 divided by KE minus G. Okay, so what I'll do is, this is the dividend, okay, and constantly here it is going to grow by 10%. okay, 10%. The G na G, growth is what? Growth in what? Growth is in EPS, growth in dividend, growth in market price. Okay, that is what. Okay, growth means what? Growth in what? EPS. It is assumption Gordon's model. The growth you are talking about what? The growth in dividend, the growth in price, the growth in EPS. So if you check here, my dividend was 8.25, KE is how much? KE 15%, and my growth is 10%, 0.1. So my 2018, this comes to 165. It comes to 165. So here it is. Let's say my dividend amount is, cash flow is, I should not have written here cash flow, I should write type, okay, or nature. So cash flow is how much? Check, 4.86, and this is 2018 to infinity, it is 165. Discounting factor is 15%. I'll calculate present value. So this is how I will do. Okay, 0.8196 0.7561, 0.7561. When I multiply this, I'll get 4.174, 4.5336, 124.75. The total comes to 133.46. This is my market price. This is what they are asking us. Okay, so this is how it will be done. Next is P ratio. They have asked us P ratio also. So price is 133.46 and earnings is how much? Earnings is, if you see here, earnings is how much? Where is the earnings? In 2016. What is the earnings? Because this price was when? This is 2016 price. Remember, this is price of 2016. So earnings should also be 2016. Remember, don't take 2019. 9.60. 9.60. So the answer comes to 13.90 times. 13.90 times. This is your answer. Okay. Fine. Now let's copy this. Okay. Next part. Now many times what happens, this companies now they buy back the shares. What they do, they buy back. Okay, buyback means what? Literally they pay you the money and the company buy back their share. Okay, so we have to calculate what is the post buyback price, that is theoretical price, what we call theoretical price. Theoretical price post buyback. Post buyback, after buyback, what will be my share price? So how we calculate this? Okay, so see, obviously the bank has the company has got excess money, so they are buying back their shares. Okay, maybe to limit the shareholding, they want to have the control over the shares. So what they do is S into P0. If you see carefully, S means number of shares outstanding, P means price of the share, upon S minus N0. Now when I say S means shares of outstanding and number of shares bought back. Okay, that is your theoretical price. Now you have to understand, when anything, any item, the supply when it goes decreases, the price goes up. Here also happening the same thing in the market. When the company buybacks the share, okay, there is a limited supply of the share, means somewhere the number has gone down, therefore obviously the price will increase. So you can write this. Okay, write S is equals to, please write this, S is equals to, complete this, S is equals to, you can write this, write the full forms also of the notations, write buyback right? Buyback, theoretical price, post buyback, right? S is equals to number of shares outstanding. P0 is equals to current price, and N0 is equals to number of shares bought back. Please write this. When you do S multiplied by P na, it is market cap. What we call market cap. Market cap we generally listen in news and all. Market cap means what? Number of shares outstanding multiplied by current market price. Okay. Question number 13. You should go through the theory and all while doing this chapter. Okay. Shankara Limited is engaged in manufacturing carry laptops. Okay. So it is engaged in what? Carry laptops manufacturing, PDAs and mobile phones and other electronic gadgets. HP and company has placed a huge order during the year, which is not expected to be repeated in years to come, because of which there is a surplus liquid fund of rupees 60 crores. Okay. Little scope for further expansion and company's policy of leveraging with debt. So what they are saying, let's go slow. They are saying that they are having a huge order, okay, and they are not expecting that there will be repeat of this order, because of which there is a surplus liquid fund. They have got the order, so they have 60 crores with a little scope for expansion. They have no scope of expansion, okay, and companies of policy of leveraging with debt means they use the debt generally for funding. Okay, so what this excess fund na, they want to use it for what? Cash dividend or share buyback. Okay, either they will give cash dividend, that is they will pay as a dividend, or they will buy back. The company has 3 crore shares outstanding with a current market cap of 240 crores required. If the whole of the surplus fund is used to buy back shares, what is the maximum number of shares that can be bought back by the company at what price? Okay, if the company were to buy back 50 lakh shares, what would be the offer price? If the company decides to declare a dividend, what will be the ex-dividend value if the given market cap is cum dividend? Let us understand one by one. If the whole of the surplus fund is used to buy back, first question, what is the maximum number of shares that can be bought back and at what price? Okay, so if you know that N into P, that is nothing but market cap. Okay, if you check the question, okay, this is given as 240. This is given as what? 240. The market cap is given as 240, correct? Market capitalization is given. Okay, so I can say that P is equals to market, no, not price, market cap. Market cap, okay, market cap divided by N will give me price. So 240 divided by N is what? 3 crore. This is also crore, this is also crore. So it comes to rupees 80. It comes to rupees what? 80. Okay. Now listen, post buyback price, how we calculate? S into P0 upon S minus N. Okay, that is shares bought. So S is what? Outstanding shares. Outstanding shares. Now listen, let us twist this question. Why we have to twist? Because the fund is given. How much fund we have? 60 crores. That is the fund. Okay, so what I do, you know, listen, I'll multiply both the side with N. So if I multiply buyback price with N, so this is the amount what I need to spend. I don't know the price. S into P0 upon S minus N, the whole is multiplied by N. Okay, now what happens is, this is 60 crores is equals to S is 3 crore outstanding shares, current price is 80, okay, upon 3 minus N, the whole multiplied by N. This is the number of shares. Okay, now let us go ahead. Now what we will do, we will solve for N. So 60 is equals to 240 N upon 3 minus N. So you have to solve for this. Okay, so how we will solve? We will solve for N. So how we solve? We will take that 3 into N. Okay, 180 minus 60 N is equals to 240 N. Okay, so 60 will go that side. 180 is equals to 300 N. So N is equals to 180 divided by 300. Answer is what? 0.6 crores. 0.6 crores, or I can say 60 lakh shares. How many? 60 lakh shares. Okay, so this is what, please copy. Understand the logic behind the formula. See why I did this? Because I don't know the post buyback price, correct? But if I multiply with n, I can buy at 50, let's say, and I want to buy 10 shares. So how much is required? 500. That amount I know, but I can't only multiply n here, I'll have to multiply it here also. So I will get this 60 crores I will use. Okay, this is all in crores. 3 is outstanding shares, current price is 80, this is market cap. So obviously minus n, out of 3 crores, n shares will be bought back. Okay, multiplied by n. So if I solve for this, how many shares I can buy? 60 lakhs shares I can buy. They have asked us post buyback price. Now what I can do is PB is equals to 240 upon 240 crores upon 3 crores were outstanding, 0.6 crores I bought back. So 240 divided by 2.4. See the market price now after post back has gone up. It is now 100. Initially it was 80. If you check here, initially it was 80. Now it has gone to 100 because the supply has decreased. Okay. Please copy this straight away. You have to apply the formula and you have to solve the sums. That's it. There is no any logic and all. Okay, behind this. Second question, what they are asking, if the company were to buy back 50 lakh shares, what would be the offer price? Means second part, post buyback price I want. If 240 is the market cap, currently I have 3 crore shares. Okay, I want to buy how much? How many shares? I want to buy 50 lakhs shares. How many shares? 50 lakh shares. So 50 lakh shares means 0.5 crore. Okay, so what is the price? Rupees 96 per share. Rupees 96 per share. Okay, this is what? 50 lakh shares. Okay, 50 lakh shares. Third part, if the company decide to declare dividend, please write. If the company decides to declare a dividend, what will be the ex-dividend value per share? If the given market cap is cum dividend, okay. So see, listen, cum dividend means dividend is included. Dividend per share, okay, the price is rupees 80 currently, okay. if they declare a dividend, okay, how I will calculate dividend? 60 crores I have, okay, and 3 crore shares I have. So DPS is equals to, how much is the DPS, dividend per share? 20. So that much the value will fall. My X dividend price is always, listen, X dividend price is 60. Now you have to understand, whenever the company declares the dividend, the market price goes down. The market price goes down by that price. That is called X dividend after removing the dividend. Okay, so it is 60. Is that clear? If 60 crores is there, I'm not thinking of buying back. I can use it for dividend. So how many shares are there? 3 crore. 60 crore amount divided by 3 crore per share will get 20 rupees. So if I declare the dividend, the X dividend price is 60. Okay. Okay, let's do the last part. It is right issue. What it is? Right issue. Okay, not right issue, bonus shares. Sorry, bonus shares. What is bonus share? Bonus means free, means instead of giving you dividend, what I'll give you is shares instead of that. Okay, so we will calculate post bonus price, post bonus share price, post bonus share price. Okay, so S multiplied by P0 market cap divided by S plus N. When I bought back, it was minus N, now it is plus N. So N is what? Number of shares, number of bonus shares, number of bonus shares. Please write. So this is easy, you can do this. Okay, next is right issue. X right price, P0 into NE X right price. Right issue means what? Right issue means if in case I have to raise the fund equity, first I will ask the existing shareholders. So it is their right. Okay, so it is called right issue. Means if the existing shareholders don't buy, now this is not free. Bonus was free. I wanted to give dividend, instead of dividend I am giving you shares. But here it is the first right of the existing shareholders to say to get the shares. Okay, in case of company is raising the additional fund. So P0 into NE means existing number of shares, plus PS means subscription price, into number of right, means per share how many. If I am having 10 and if my right is 1, that means for 10 shares I can buy only 1. That is my right, NR. Okay, divided by NE plus NR. There is no rocket science in this. When price is multiplied by existing number of shares, I get market cap. That again, price of subscription multiplied by right share means how many new shares I am getting at what price. Again market cap plus market cap divided by number of shares, you get price. That's it. Okay, please copy. Last question. Theoretical value of right, okay, that is X right price minus right issue price. Okay, this is one way, or another way, theoretical value of right per existing share is equals to theoretical value of right the whole divided by right ratio which will be given in the question. Right ratio, how much for the existing shares, how many rights you have, okay, that. Question number 14. ABC Limited shares are currently selling at 13, means current price is 13 rupee. There are 10 lakh shares outstanding. The company is planning to raise 20 lakhs to finance the new project. Means see, they want extra money, 20 lakhs. What is the ex right price of the share and the value of the right if the company offers one right for every two held? Means if I have two shares, I will get one share. Second option, if the firm offers one right for every four held? Means if I have four, I will get one right. How does the shareholders wealth changes from A to B? Means you understand, A to B means from A, if for 2 you get 1 and if for 4 you get 1, you are also the shareholder, I am also the shareholder, okay. It does not affect if you claim for the right, means you also claim the right, I also claim the right. Whatever, how many shares we hold, that does not make any difference. You might be holding 1000, I might be holding 100. If you also claim the right, means you also take that chance of buying the right, I also take the chance, full right, then there will be no change in our wealth. But if any one of us is not able to take chance of that right, means I don't want to buy, if I think, okay, or you think you don't want to buy, then obviously it is going to affect our wealth, okay. So we'll see this with the help of number, okay. So let's start. So first is current price is what? P0, they have given P0 is rupees 13, existing shares is 10 lakhs, okay. So formula is what? X right price. Formula is what? P0 into NE plus PS, subscription price, multiplied by number of rights divided by total shares, NE plus NR, okay. Please write. Let us write all the formulas first, then we will do in a table, okay. Let's complete this in a short way. Theoretical value of right is equals to X right price minus right issue price. Theoretical value of right per share, this was the formula. Again I am writing the formula so that you can understand, we will remember. Theoretical value, okay, per share divided by right ratio, okay. Let us do this. Ratio, first column, two ratios are there, 1:2 and 1:4, okay. Number of right share, issue price, X right price and right value. So ratio is what? 1:2, okay. So that means number of right shares 10 lakhs divided by 2, number of right is 5 lakhs, okay. How many shares you will issue? 5 lakh shares, okay. How I'll calculate issue price? I want to raise 20 lakh shares divided by 5 lakh, so my per share should be issued at 4 rupees. Please understand, 20 lakhs I have to raise, 5 lakh shares I am going to issue, so per share is 4 rupees, okay. Now I'll apply that formula above what we wrote now. Current price is what? 13 multiplied by existing shares is how much? 10 lakhs. Okay, plus number of subscription is 4 multiplied by new shares is 5 lakh, means again 20 lakhs, divided by 10 lakh shares plus new shares are 5 lakh, 15 lakhs. Okay, check what is the value. Rupees 10. Rupees what? 10. Okay, rupees 10. Listen, see, there are two ways to calculate the right value. One is this X right price. X right price is how much? 10. This is my X right price minus right issue price. Right issue price is how much? Issue price is 4. So 10 minus 4, answer is 6. Or theoretical value per share. Theoretical value per share means what? What is the value of the per share here? Okay, theoretical value means what, sir? 1 minute, understand. That is, see, X right price is 10, issue price is 4. Okay, so the value is, this right value is 6. Right value is how much? 6. Theoretical value per share I have already calculated, that is 6. So that 6 divided by right ratio. Which ratio? Right ratio. Please, you do one thing, copy this much first, make a table, copy this much. Okay, done. Listen, now here 6 is my value of the right. What is the ratio? This is the second formula. Value of the right 6, the ratio is 2, so right of the value is 3. This is the two way to calculate, okay, value of right. That is, please understand, 10 rupees is what I am, means is the issue, this thing, what X right price after the rights. Okay, 10 is the price. How much I paid? 4. So what is the value? 6. Common sense. If 6 is the value, okay, per share it is how much? Per share, if 2 shares for 2 shares I am getting 6, it means per share it is 3. Okay, next, same way complete the next part. Try to complete the next part. 1:4. 10 lakh divided by 4 is equals to 2.5 lakhs. 20 lakhs divided by 2.5 lakhs is rupees 8. 10 lakh divided by 4 is 2.5 lakh shares I will issue because I want to raise 10 lakhs. Okay, 20 lakh divided by 2.5 means per share price will be 8. The issue of the right issue will be 8 issue price. 13 into 10 existing market cap plus new market cap, that is 8 into 2.5 divided by number of shares. Okay, here you will get 12. So my ex right price is 12. I bought it for 8. So the value is 4, or 4 divided by 4, the ratio. Okay, the answer is rupees 1, like this. The answer is rupees 1. Okay. So whether you are getting bonus 1:2 or 1:4, and those who opt for the right, not bonus, right issue, they will never, their wealth will never get eroded. Okay, and wealth will not increase also, neither it will increase. Initially what you and me had the wealth, if we opt for the bonus also, then to right also, then to it will, the wealth will be the same. Let us write this. Okay, this was the C part question. Change in shareholders wealth. Change in shareholders wealth. Change in shareholders wealth. First point, since right issue is constructed, since right issue is constructed in such a way so that shareholders proportionate share will remain same, in bracket unchanged, that is, wealth does not change for change in ratio from 1:2 to 1:4. 1:2 to 1:4. Right issue does not increase shareholders' wealth if he renounces his rights. If he renounces his rights, means if he takes his rights. However, if a shareholder ignores the right issue, there will be reduction in shareholders' wealth. Okay. How does the right issue increase? So right issue does not increase the shareholders' wealth. So we have done with C part also. Okay, fine, that's it. Okay, clear. So we complete this chapter here. There is something called as a stock split. Stock split means what? Means, let's say sometime what happens, the market price of the share goes up so much now that we had in the Indian market the share price, the stocks which had a share price of 90,000, 1 lakh. So retail investor can't invest in that stocks. So what these people do, they split it. Means if you are having one stock, you will have 3 stocks, and the price also gets, means 3 times lower. Means if it is 90,000, per share becomes 30,000, so that it is accessible for normal person. MRF, Isher Motors, all these are examples which had a huge share price. Okay, so this is called stock split. Does stock split changes the owner shareholders wealth? No. Never. Okay, if you were having 2 shares and I was having 1, so I will get 3, you will get 6. Ultimately the ownership proportion remains the same. The opposite of this is reverse split. Reverse split means what? Consolidating. Okay, let's say the share price is very small, so 10 paise, 20 paise, we want to make it bigger, so we consolidate. Okay, means 3 shares becomes 1, like that something. Okay, so we are done with this chapter. You should go through this. Okay, there are some theories which I have not done. Okay, you have to read it. Okay, or other things, whatever is important that I have covered. Okay, thank you so much.